Looking for deals in this crazy stock market? Want a market-beating dividend that's growing at a double-digit rate? Interested in riding the wave of a stock that's up almost 60% over the last 6 months? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a bank holding company taking advantage of one of the oldest and most attractive business models known to man. Banks have been around since about 2000 BC, so let's just say they have some staying power. It's a lucrative business model that isn't getting any less appealing. And the best banks in the United States are highly adept at pumping out growing profits and dividends to their shareholders. This stock is one such bank. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Third Bancorp, which appear to be trading at a significant discount today. Third Bancorp, stock ticker FITB, is a diversified regional bank holding company that offers a range of financial services and products such as deposits, lending, transaction processing, and advisory solutions. Founded in 1858, Third Bancorp is now a $23 billion by market cap major regional institution that employs almost 20,000 people. Headquartered in Cincinnati, Ohio, the bank is primarily focused on its core Midwestern market that includes the states of Ohio, Michigan, Illinois, and Indiana. As of December 31st, 2019, they had $169 billion in assets, making them one of the top 20 largest banks in the United States. For perspective on that, there are over 5,000 commercial banks and saving institutions in the United States. The bank operates 4 main businesses: commercial banking, 57% of fiscal year 2019 net income, branch banking, 34%, wealth and asset management, 4%, and consumer lending, 4%. There's no doubt whatsoever that the last few years have been difficult for banks. Between persistently low interest rates, a long recovery from the Great Recession, and now a global pandemic, banks seemingly cannot win. Because of their unpopularity, bank stocks were practically ignored by investors, and this pushed down valuations to levels that implied they'd never grow again. Yet banks are growing, healthily. And now bank stocks are popular. Third stock is up almost 60% over the last 6 months. However, even after this sudden resurgence, the stock still looks attractive. It was pushed down so far for so long that there's a lot of coiled spring to unwind here. And while that spring unwinds, investors can look forward to collecting a market-beating dividend that's growing like clockwork. The company has already increased its dividend for 10 consecutive years. Their 5-year dividend growth rate is 15.1%, which handily beats any kind of inflation. That growth comes on top of the stock's yield of 3.2%. This yield, by the way, is more than twice as high as what the broader market offers. It's also 40 basis points higher than the stock's own 5-year average yield. With a payout ratio of 59%, the dividend is easily covered, and that's after using depressed GAAP earnings per share. Once the bank moves past the pandemic, reserves will be released, and the payout ratio will drop as a result of rising earnings per share. I love dividend growth stocks in what I call the sweet spot. The sweet spot is a yield of between 2.5% and 3.5% paired with a high single-digit dividend growth rate. This stock is clearly right there. Looking at business growth, Third has grown its revenue from $6.33 billion in fiscal year 2010 to $7.253 billion in fiscal year 2019. That's a compound annual growth rate of 1.52%. Notably, I'm using fiscal year 2019 as the most recent fiscal year. That's because the full year revenue numbers are not yet available for fiscal year 2020. There have been minor reshufflings and sales of various business units over the last decade, which caused some volatility in top line results. There was also the acquisition of MB Financial Inc. for $4.7 billion in 2018. The overall revenue trend is positive. Meanwhile, earnings per share increased from 63 cents to $3.33 over this period, which is a compound annual growth rate of 20.32%. What's incredible about this is that it happened during one of the most difficult periods you could imagine for a bank. A combination of buybacks and large improvements across the board helped to propel some of this excess bottom line growth. While extremely impressive, this earnings per share growth rate is a bit misleading. The starting year, which is fiscal year 2010, had an abnormally low earnings per share result. However, even if we look at more recent 5-year stretch, earnings per share compounded at an annual rate of 13.45% between fiscal year 2015 and fiscal year 2019. Looking forward, CFRA is anticipating that Fifth Third will compound its earnings per share at an annual rate of 7% over the next 3 years. This would be a deceleration in growth compared to what the bank has historically enjoyed. On one hand, CFRA is concerned about limited loan growth and a compression in net interest margin. Low interest rates are a weight on banks. On the other hand, CFRA sees strong corporate banking revenue, higher investment advisory fees, and a recovery in service charges on deposits. CFRA likes Fifth Third's improving profitability outlook and diversified product set that generates a lot of fee income. One unique aspect about this bank relative to Midwestern competitors is their deepening exposure to the Southeast. Fifth Third expanded into Florida years ago, which is a market the bank is doubling down on. With Florida being a very popular state to move to, Fifth Third should benefit. Rates are low, but they have almost nowhere to go but up. The wild card here is obviously the pandemic. Without that, CFRA's forecast looks very conservative. But with so much near-term uncertainty, I like the caution. Even if this lower earnings per share growth rate were to manifest itself, the bank could still grow its dividend at a high single-digit rate, and that's certainly appealing with the 3% plus starting yield. Moving over to the balance sheet, the bank has a solid financial position. They have total assets of $169.4 billion against $143.9 billion in total liabilities. Credit ratings for their senior debt are as follows: BBB plus from S&P, Baa1 from Moody's, and A- Fitch. The bank's profitability is strong. Over the last 5 years, the firm has averaged annual net margin of 30.30% and annual return on equity of 11.92%. Net interest margin came in at 3.31% for fiscal year 2019. There really is a lot to like about this bank as a long-term investment. Banks are one of the oldest and most attractive business models of all. A large float is a competitive advantage for an entrenched bank that operates at scale, and the sticky nature of deposits means this competitive advantage is not easily lost once gained. Of course, there are risks to consider. Competition, regulation, and litigation are omnipresent risks in every industry. Pervasively and persistently low interest rates continue to challenge banks. Banks are highly exposed to economic cycles. The current cycle is one of the most uncertain cycles anyone has ever seen. Any lasting effects from the pandemic and economic shutdowns could leave a lasting scar on the bank. If the pandemic were to lead to a more long-term recession, this would hurt the bank in two ways. Less economic activity limits loan and deposit growth, and loan losses harm the balance sheet. With these risks out in the open, I still feel that this business has excellent long-term prospects. And while the valuation isn't as incredible as it was 6 months ago, the stock still looks at least moderately undervalued here. The stock's PE ratio is 18.3. That's based on fiscal year 2020 GAAP earnings per share, a number that has been pressured by reserves. Once we move past the pandemic, GAAP earnings per share should rebound sharply, and this PE ratio will shrink in short order. Even with depressed earnings per share, the PE ratio is still lower than the broader market's earnings multiple. In addition, the stock's price to cash flow ratio at 7.1 is materially lower than its 3-year average of 9.8. And the yield, as noted earlier, is markedly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. In my view, this is reasonable, if conservative, growth assumption. This is right in line with CFRA's near-term earnings per share growth forecast. It's also quite a bit lower than the bank's demonstrated long-term dividend growth rate and earnings per share growth rate. With so much uncertainty, I'd rather err on the side of caution. The dividend discount model analysis gives me a fair value of $38.52. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates FITB as a 4-star stock with a fair value estimate of $35. CFRA rates FITB as a 4-star buy with a 12-month target price of $36. I came out slightly high this time around. Averaging the three numbers out gives us a final valuation of $36.51, which would indicate the stock is possibly 9% undervalued. Here's the bottom line, guys. Fifth Third Bancorp is a quality regional bank that has shown an exceptional ability to grow in a challenging environment, and deepening exposure to one of the fastest growing areas of the United States gives them a bright future. With a market-beating yield, double-digit dividend growth, a moderate payout ratio, and the potential that shares are 9% undervalued, this dividend growth stock is still on sale. And for a special news announcement, I want to alert you about another bank, JPMorgan Chase & Co., stock ticker JPM. They recently announced their credit card delinquency rate for January 2021. It came in at 0.99%. That's actually lower than the pre-pandemic January 2020 delinquency rate of 1.14%. We did a video on JPM last summer when the stock was below $90. While the stock is now much higher at $145, this is a fantastic bank to own for the long haul. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.